Welcome to Financial Media. As always, I'm your host, Ken McGrath, and today we'll be discussing the time at which you invest. Now that we have said that, we're going to get started. The first order of today is that independently financing your overall investments and increasing your overall outflow investments doesn't matter at which age you start. You can start at the age of say 5 for imagine your own dad or your mother could just start investing for you and increase your overall assets. You could start at 21, my age currently. You could start at the age of 40, 50, 60. It does not matter at which the age you start investing. What does matter is that you start now. That means investing has a great long-term effect. Investing in overall creates and allows for your assets to increase through compound annually, quarterly, or monthly. In fact, increasing your overall gains come from this compound effect. In this stance, as an individual investor who invests on their own, I currently have been investing for about only roughly a year. And I've noticed around a 12 to 15% gain on my assets within the stock market. With this in mind, the average return on a stock market is 10%. And all you have to do to get started is to simply set up an account, whether it be Fidelity, Schwab, Vanguard, and a whole bunch of other brokerage accounts that you could utilize for yourself to gain a little bit of awareness. Starting this can allow for you as an individual to wanting to learn more about assets, liabilities, learning more about, balance sheets, overall compound interest, dividends. There are a variety of financial terms that you could learn when you start investing. I didn't know anything starting when I was investing. I lost the money, but I started learning, researching, reading more books. And it allowed me to shape my overall destiny today. All you have to do is start now. The earlier you start, the greater your returns will be. Either or, investing is I would believe, a good skill that one can attain and learn from, and as well as increase their overall financial stance in life, allowing for them to get stronger mentally and emotionally, increasing their overall demand, in which they learn more, which attentively helps their overall mindset in the long run and helps them become more successful. Therefore, we're going to get started in the next clip, which will show a brief little intro of an investment calculator that shows you how much you could really have if you start investing now. We're now going to dive into this compound interest calculator that I wanted to show you. So give or take, say that as an investor, you start off with $0 and you want to contribute, say you were 20 years old, just average it out, 20 years old, starting young as an investor, and you contribute $100 each month, and we're going to put a 30 limit years. So, roughly 50 years, about 20 to 30 years of investing, $100 monthly at a 10% interest rate annually, compound annually. Calculate that we will have roughly $197,000 by the time 30 years. Now, the compound effect doesn't really take effect until, as you could see, year 20. That's why the earlier you invest, the higher your chance of compounding your money over the long run. Now, let's say, give or take, you want to contribute roughly what a rough IRA is, which is like $500 a month, to equate to roughly $6,000 every year invested. And you do this for 30 years. At the same rate, 10% interest rate, you would see $986,000. That's almost $1 million by the age of 50 that you could have. Now, if you want to step that up and say, I don't want to retire until the age of 60, you could have $2.6 million. That is a lot of money. That is enough for your overall assets to be paying you as your dividends will compound, which we'll talk in a later video. But This equation to the amount of money that you could have is only in stance to the amount of years you provide and consistently invest. If you don't consistently invest and put this amount of money, you're not looking at it as a higher gain. You're actually setting yourself back. So providing a consistent, source, which you could hear in my first video talking about consistency, the first two steps of success, which you could watch, demonstrates basically why it's important to be consistent and how you as an individual could succeed. That having this divine wealth comes from compounding effect. And some of the greats like Warren Buffett and Charlie Munger didn't really make a lot of their millions and billions of dollars until later. They made basically like 90% of their overall portfolio came like later in their life as the compounding effect took place, but allowing them to build their overall amount of wealth came from investing year and year over year, regardless of bear markets, regardless of bull markets, and just dollar cost averaging into the market consistently. Just like you said, $500 a month doesn't hurt. Now, if you're a crazy investor and you have a lot more money, you could roughly invest over $1,000 a month and say you just do it for 40 years. Well, this could get you to 5 million. The higher, the more value you put into your account, the more money you put into your account, the more gains you'll have, the higher the compound interest will take place. Now, roughly is 8 to 10%, but we're going to be conservative here and say 10%. That's why we're getting these high numbers. But reality is, if you consistently invest over a long period of time, you will have great returns. Thank you for watching this video. Make sure to comment down below and like and subscribe.